So good evening, everyone, and thank you for joining us for our seminar on investing together, real estate co-ownership. And I'm really excited about this topic. We have Niles Lichtenstein, who is the owner and founder of Nestment, and you'll be hearing more about it as we go along. But it's a great company to be able to help people. It's kind of they're at the forefront right now in terms of real estate trends and really helping people to understand how they can team up together because housing prices can be pretty high in our area and elsewhere as well. And so a lot of millennials, Gen Z, multifamily are taking advantage of this co-ownership model so that they can be able to afford buying a home or investment property. So before I get to Niles, I'm going to do a quick market update and then I'm going to go ahead and take it over to him. So with the market update, this is for April. As of April, median sale price is the price at which you have the number of homes selling above a certain price is the same number as selling below that price. So in this case, for April, for single family homes in San Mateo County, um, well, you can see this goes all the way back to 2010. That's 15 years ago. And as you can see, you can almost draw a straight line going up, right? Even with all the ups and downs, this is coming soon after the heels of the Great Recession that we had in 2008, 2009. And then from there, where the median sale price was around 500,000, it's literally gone up, and steady. We did hit an all-time peak right here in April of 2022. That was at 2.25 million. And then we actually started coming down. Sorry, this is, yeah. And so then from there, we started coming down as the interest rate started bumping up to where toward the end of the 2022, we were actually coming back down to around 1.5. And then since then has gone up again. So we hit all-time high in May of last year, 2024 at 2.3 million. And then again, that kind of adjusted as the year went along. And then, so as far as April, we're at about 2.1 million for median sale price, which is still not bad. So again, it's almost as if you do see the ups and downs, up and downs, but again, you can see that it's almost as if we've just had a gradual, increase. If you could almost draw a straight line through all of this, considering, post-COVID, post-interest rate hike, et cetera, even keeping all of that in mind. And so we're still staying still pretty steady for this year so far. January was at 1.795 million. And then since then, it's so that's this little dip here, right? For February, March, and April have all been above 2 million, above the $2 million mark. And so we are seeing that, you know, the prices are holding very well. The next metric I like to use is months of inventory, and this has to do with if you were to take the number of homes that are on the market and just sell them, how long would it take before we run out if we didn't introduce any new inventory? 6 months, as you can see up here, is considered a balanced market. And then anything below that, above that is considered a buyer's market. There's a lot of inventory. It's going to take a long time to sell it out. Anything below that is considered a seller's market. And so, as you can tell from pretty much from 2012 and on, we've been in a solid seller's market with low inventories. You can see a huge dip right here in, again, post-COVID. During COVID, everybody was a little nervous what's going to happen. And then 2021, market just took off. And you can see that the inventory levels were at 1 month levels. And so if there was no new inventory coming on, literally we would just run out of things to sell in a month. And that's pretty mind-boggling. But it has since then gone up and down to about the 2 month mark, a little above, a little below the 2 month mark. For April, we were at 1.6. So January, February, we were right around 2 months. And then March and April, for March, we were at 1.8 months of inventory. For April, at 1.6 months of inventory. And so regardless of the interest rates, regardless of everything else that's going on around us and the uncertainty in the economy, we continue to have record low, or I can't say record low anymore, but we continue to have low inventory levels, which continue to make it challenging. And that's part of why the prices are staying up, pretty solid as they are. And then days to sell is the third indicator that I would look at, which has to do with how long does it take when you put a house on the market until it actually gets into contract. So this does not include the escrow period. And from there, you can see that it's been, again, since 2012, staying up around the 10 to 15 day mark. There have been these peaks at times. In general, those tend to be near the end of the year. So like a January, you'll see these are in January or December, just because people are kind of not as active when they're on the market. And then there was different reasons for slowing. Again, 2000, at the end of 2022, we did see interest rates change pretty significantly, and that impacted the buyers out there who were seeing interest rates go from 3 to 6 and 7. And so that kind of chilled the market a little bit. And so you could see over the course of the year, the days to sell increasing to where the beginning of January, we actually saw it closer to 30 days. Since then, though, it's again readjusted to where your days on market, the median days on market are anywhere between 10 to less than 20. So 10 to 15 or so. And just to think about that, that's considering you put a house on the market, maybe have one open house, maybe two, and then you're done. And that's what we're continuing to see in the market. We will see what happens because May is traditionally, we're starting to kind of wind down as people get ready for summer and all the summer travel. So June, July, August tend to be take a little bit slower, but not very much so, just because we have still inventory levels that are low. And then the interest rate, which is the big story that we're constantly hearing, has been fluctuating as this goes back for 10 years. And you can see that we had all of the interest rates in the 4% range for a 30-year fixed rate mortgage. In 2021, we're down to about the 3% rate. And then 2022, you could see that it just made this big increase, and that definitely impacted buyer sentiment during that time period. But since then, it's been pretty much bouncing up and down around the 6%, 6 to 7% mark. Toward the end of last year, we were seeing a little bit. I'm sorry, toward the end of 2023, we were seeing it getting closer up to 8%. But since then, we've seen some fits and starts. But pretty much even now, with all of the uncertainty in the economy and different talks of tariff, some talk of recession, some talk of inflation continuing, with all of that happening, literally in the last couple of months, every time we get a mortgage update, it's somewhere in that 6.5 range. It can go a little higher, a little bit lower, but we're pretty much staying in the sixes at this point. What people are expecting is, we might be able to maybe get some rates cuts going down a little bit, especially if we do go into a recession. But so far, it's pretty much holding steady. And the buyers out there, we're seeing that they're not that impacted by the rates anymore. They're not thrilled if there are buyers who had a 3% mortgage already and they're thinking to change, then yes, they might be more impacted because that's something to really think about if you're going from a 3% to a 6.5% mortgage rate. But if you're not in that situation and if you have a new buyer, all they know is 6%. So over the last 2 years, it's been in that 6% range. And I think more and more people are getting used to the fact that they just need to buy something that they like. And then, if the prices are going to continue to increase, it's better to get in there. And then if the rates ever do drop, or they will at some point, do drop to a certain degree, then they'll be able to refinance. Nobody is anticipating that we're going to come back to this for a very long time, if ever. So, the days of the 2.5, 3% mortgage rates, probably not in our near future. You never know, but so far that nobody that I'm listening to is predicting that. So with that, I'm going to go ahead to let Niles take over, and I'm really excited to have him come in. And I hope if you can start out, Niles, with a little intro to yourself and your company, that would be great.
Sure,
Thank you.
happy to. Thanks for having me, Gene. Thanks for that market update. But let me do a quick introduction. So, our company is called Nestment. I'm the CEO and co-founder. Our tagline is home ownership is so possible because if you talk to millennials and Gen Z, the word around home ownership is impossible oftentimes, right? So our focus has been building new on-ramps. So how can we start to mainstream actually a lot of strategies that frankly have sometimes been on the fringes or people have done, but there haven't been a mainstream way to do it. But we've been able to do that, put the right kind of lenders and great agents like Gene and so forth together to make sure that home ownership is made possible. And we'll talk a little bit more about that. A little background, and you'll hear the term house hacking a lot as well. I know hacking is a pretty popular term, whether you're on TikTok or IG, and how to essentially find a path towards an outcome that's good for you. That might be a different path towards that. But I always kind of call myself an original house hacker, trying to make the Bay Area affordable. It really starts for me, when I was born here in the Bay Area, was raised in the People's Republic of Berkeley, across the way from San Francisco, where I am now. And when my father passed when I was younger, my widowed immigrant mother didn't have a job, but she had two boys. We were very fortunate. We had a home. That home had increased in value. So, and she was smart and scrappy. And so I learned at an early age, at 13, how to refinance a house and take out some equity that we could live on. And then we rented out rooms to international grad students. So grew up with Nigerian math PhDs and Swedish physicists. And outside of having to share bathrooms and being in the living room sometimes, it was actually a pretty fun upbringing. But it always really resonated with me that because we had this asset, we were able to have some stability there, and that was really meaningful to me. I went to Harvard for undergrad, came back, was fortunate to have my first startup in the mobile tech space be acquired, and the joke from my cousins and friends was that's what had to happen just to afford. It was around 2012, 13 at the time, and so what I decided to do with some friends and cousins is buy my first kind of multifamily. So 2 to 4 unit triplex in this case in Oakland, and allow us to own it together, live there together, not have to pay rent, but pay it into the equity. And then ultimately, what was one of the most meaningful moments was refinancing that particular property, and giving everyone a sizable check. And now they also had a rental property, and they moved on. But found myself kind of repeating this, and just it became a kind of a second hobby and passion for myself. And so and even in the city now, I live in Nob Hill, and own a triplex with another family, and we rent out units, and I live in the top unit and have my beautiful, wonderful family there as well, vacation rentals, etc. At my second startup, a New York Times funded startup that's now a sustainable SaaS company, I had a lot of colleagues who were going through similar things as me, getting into our 30s and saying, "Hey, we really want to afford." And so they reached out and said, "Hey, all those things that you did, how did you do them? What's the co-buying thing?" And so all credit goes to them. They came up with the term Nestment. I was like, "Hey, maybe we can throw a landing page out and see if other people are interested." And we started with the concept of co-buying, but I'll show you how we've expanded on that to really kind of think about some other strategies. But we threw a landing page that said, "Buy property together with family and friends." Flighted some Instagram ads, did a LinkedIn campaign, just had an email sign up. Next thing we knew, we had hundreds of people signed up for a product that didn't exist at the time. So it was a good indication that it was time to build something. Started doing the research, and it was 2022, and rates were rising. So most people were like, "I'm even more in that situation than I ever was before." And I am proud to say that those colleagues became my co-founders, and they've also used Nestment to buy their own properties, and we'll talk a little bit more about that shortly. The thing that we focus a lot on is that the desire to become a homeowner has never been higher. I don't know if you're hearing this too, Gene, or folks on the phone, but there's this moment of economic uncertainty, but the things that we're hearing, and we run a program called NestGen, which is the first I think home buying accelerator that's out there, mainly for first-time home buyers. is that they want a sense of control and certainty, and so they actually want to be able to own a home, right, in these times of uncertainty. And I always, we always track this Bank of America survey, and I think this was the first, or yet last year was the first year where home ownership was more important than marriage, kids, and even career. But at the same time, we know that opportunity for home ownership has never been lower, especially in these high cost areas. At 24%, we've hit our lowest ever first time home ownership rate. At 38 is the median buying age, right? That used to be 31 10 years ago and below 30 a little bit before that. And then the thing that I get concerned about is just this net worth gap between owners and renters. And again, I go back to my own story of if we hadn't owned that home, being able to have that asset was really, really helpful. So the way that I think about things, and then we'll go into the specific strategies, and I'll take a beat in a couple slides because I'd love to hear if there's specific questions that you all have. But I look at this as there's actually about 600,000 transactions out there that were happening in this in a normal kind of or I would say not normal, but like in the past, you'd see it's about 600 more first-time homeowner transactions. But because rates, have stayed high and prices, as you just saw from G's, haven't really gone down at all, you end up in a situation where people are not able. The thing that we are discovering is that a lot of these buyers are actually one strategy or one program, sometimes even one conversation away from ownership. But that small distance plus what they hear makes them feel like ownership is an impossibility. So we look at this kind of group, and what we start to do, and I'm not going to go into all the details, is we're able to help kind of categorize and build a profile to then align them with specific strategies, and have those strategies build out a financial report, make sure that they have the right agreements and legal, get connected to the lenders that are going to make the most sense for them, depending on the program they need or the type of mortgage or things of that nature, and then make sure that they have an aligned agent who can understand everything from co-buying to house hacking, which we'll all cover in just a second. We'll cover three strategies: primary multifamily, which we oftentimes call house hacking, rent vesting, and then co-buying as actually a layer on top of these. Just I think in this past month, multiple kind of multi-generational co-buyers together, and there's been different forms of that, right? And I think we have, we kind of honor each form. Sometimes it's how do we gift the money? Sometimes it's how are we co-owners together? Sometimes it's how are we living together? We just had a duplex in San Francisco where now it's grandparents, parents, and then their two-year-old twins, right? Like, and they realize that cost per square foot in a place like San Francisco have to come down. And we've got someone who just bought a triplex in Eagle Rock in LA. That was, we'll go through kind of all of those things, but it was a way for him to replace his rent, right? And start to, and also to manage the other two, or have someone or have some help with management, but then having those properties or those additional units kind of pay. And so we'll talk about all of those. And yeah, feel free. And then I'll make myself, available. Anyone who shows up to these, I get to take about 10 groups or 10 buyers myself every quarter. We have a bunch of amazing coordinators, and then obviously we connect and make sure that we're connected to their agents, in this case, Gene. But always happy to make my calendar available for you all. So it's the fun part of the job. I have to do a lot of things as CEO, and the best part is working with buyers and groups. So I'm going to first start with primary multifamily, right? And so this can be done by one person, two people, co-buyers, and we'll talk a little bit about it because you can have up to four co-buyers on a qualified mortgage. I mean, one of the most interesting things I discovered, you'll hear me go on little tangents, is that, oftentimes you talk to like loan officers that just don't have the autonomy or the ability to think creatively. There's some amazing ones that do as well. But what we found was, oftentimes people were in situations where they had a third or fourth co-buyer, but the application only had two names. And then the LO that they were talking to said something like, I'm not sure how that's going to work on the back end, right? But typically, qualified mortgages, you can have up to, Fannie and Freddie mortgages, you can have up to four co-borrowers on that mortgage, right? So it's just something to think about where small adjustments that are of things that are actually already mainstream, can change or make the difference for folks. But we have all types of ways in which people look at co-buying. So, but the point here is being able to exchange your rent. I think of it as almost like renting to myself, right? And living in one part of the home or the multi-unit, having a long-term rental, or you could have a friend or family live in the other unit as well, and then sometimes we'll see people, there'll be a third unit or fourth unit. Now, things to know, over 4 units, you get into commercial territory, right? So what you want to try to do is stick in between 2 and 4 units. And it's perfect because one, you can get a primary mortgage rate. So that's going to be 75 to 100 basis points better. So 0.75 to 1% better on interest rate than a commercial, right? So you leverage that. The second thing that people don't always know or talk about is the fact that, let's say, obviously you're doing well as a teacher and engineer, but what's interesting is they'll still take the rental income from the other units. Even if they're not rented, they'll put it at market rent, and they'll take 75% of that additional revenue and add it to your income, right? So that actually helps you qualify for a higher loan amount. And then the last thing that we will kind of touch on too is that now with the new Fannie program, you can put as little as 5% down for up to certain thresholds. And in the Bay Area, it's not as it will. Different parts of the Bay Area are easier. Oakland, Richmond, some parts of the East Bay, a couple parts of the South Bay and North Bay, but you can get up to a $1.5 million loan on, say, a quadplex with putting as little as 5% down. Now, you can kind of work on the margins there. So if you have like 100, 150, and this is something that we work with each person on, how much more you can get. But those are kind of some of the loan limits that allow you to put as little as 5% down. Now, the thing you have to then watch out for, and then I'll show you how our platform kind of calculates this for folks, is that then you've got obviously this larger mortgage, and then you have something like PMI, private mortgage insurance. The unique thing about primary multifamily homes is that you have the ability to, well, one, you're buying it at a cost per square foot that's usually 20 to 30% less per square foot, right? So I'll give an example. I'll share my personal home with you guys, if you don't mind. Here, I'll share this one. So this is my wife. She designed our top floor of a 3 unit building. If we were to buy this same, couple thousand square feet in middle of Nob Hill, would cost me about 1,100 per square foot. Even after renovations, it came up to about 700 per square foot. Now, the middle floor, which is a 4 bedroom, 2.5 bath, and the bottom floor, which is a 3 bedroom, 2 bath, those tenants don't say to me, well, you bought it for less per square foot, so I'm going to rent it for less. They actually rent it out at market rates. Now, obviously, you have to be thoughtful about if they're current tenants, what's going on there. But that arbitrage essentially between that 20 or 30% purchase and what you get on market rents makes up and allows for that other unit to be subsidized. Does that make sense? And I'm just showing you random. You can make it your own. And sometimes people feel like, well, it's not my white picket fence home, but I like to show our home as a place that, we really made feel like our home, there, and has really allowed us to stay and use the money that we save, and the 2 other units pay for this unit. So that's kind of just an example of why kind of primary multifamily can be really, really, really advantageous. Don't tell too many people or everyone will be doing this. No, just but it's an exciting opportunity. So you've got rental income coming in. You can put less down. If you could put the 20%, that's obviously better. There are certain places and there's certain programs. Right now we're working with City on a new program called the Home Run program, which can get you a duplex and at 3% down with no PMI. So there's some interesting different kind of programs that are out there, and we depending on your location, I guess I'm sure you guys are all Bay Area, but we work across the U.S. There's different types of programs. As mentioned, that price per square foot is there, and then you just have some really nice flexibility, and then you also have your tax write-off. So appreciating asset, subsidized rental income, and tax write-off, both for the primary portion of the unit or the building, and then also the depreciation or investment portion. The other thing that this also becomes really interesting as well, and maybe it goes to your question a little bit, Cindy, is that you actually sometimes find that you have friends or family who are also interested in investing in this. Sometimes it's not direct family, sometimes it's friends, because they're like, hey, I've been looking to invest in real estate. And in fact, you can essentially own the portion you're living in and say a duplex, and they're owning the other portion, which is the rental property portion. But now you own 50% of this appreciating asset, and you got that X amount of square footage for a discount, right? So there's definitely ways, what I say is we'll talk if anyone's interested on this call or webinar, and we can go through just to show you guys some of the things that we have here in our system. We have a way to actually take in any property. We look at everything from, we pull core logic data on projected appreciation. In this case, this was a single family home with an ADU and a granny unit. We pull in the rents. They can adjust the rents, pull in kind of what the profit would be, what goes towards principal. So all of that stuff allows us to kind of financially project with some reasonability, to help you figure out, hey, between all of us going in, what's our share? How much is it going to be? How much is it going to cost? So yeah, so that's kind of primary multifamily. The other things to think about is that with things like the Fannie Mae program, you have to live in your home for the first 12 months. So whatever unit, you don't have to live in all of the units. You just have to live in one of the unit as a primary home. And that has to be seasoned for 12 months. Then you can move on if you'd like, right? So a lot of
Question.
time, go for it.
Oh, sorry. Who is
Yeah.
the you? For example, say you had four people on a loan
Yep.
and one of them is your child, and it would be the child who would be living there. But who
As
has to
long
live
as
there?
it's one of you on
Okay.
that loan who is living in there, you're good.
Okay, great.
That it's going to be the primary home. So, for instance, I'm working on a duplex right now. Actually, Gene, I don't know if you know Celeste, right? But I think she works with Brian. But her son's buying in Reno, Nevada, right? And he's buying a duplex, and they're helping him, kind of co-own with him. But he'll own one unit and live there. But because he's the primary, he gets all those benefits. Yeah, and then obviously, we look at kind of tenants, and as you're going through the process, especially with your agent, and you're looking at, who are the tenants there currently, what are the current rents being paid, and all of that stuff can factor into what we call the Nestment in our platform that helps you kind of calculate the financial projections. And then, the other big question goes to, I'll be honest, we've had a ton of parents actually really, say to their kids who are in their 20s and 30s, and it's not your kids, it's adult children really, like, hey, do you want to manage that? And that's an important conversation, right? Because, for some people, it's actually a really great opportunity to manage. I love having all of my buildings managed for me, right? And in fact, the joke is that sometimes I'll be living in a duplex or triplex or quad where no one knows I actually own the building, and there's a manager, and he's also my super as well. So my honey-do list goes down because of that. So you can also have a manager, and it's typically somewhere between 6 to 10% of the rental revenue. And there's a place in that calculator that you can add that to. So mine is around 6% or so of the rental revenue. So Weldon and John are a great example. They, two engineers in Oakland, them and their wives have been looking for single family homes. they just felt like the goalposts kept moving for them and it was getting really frustrating. But they ended up, buying a $1.6 million quadplex. They put about 100K down, so they got a chance to put less than 10% down with the Fannie Mae program. And they live in 2 units and then rent out the other 2 units, right? So their videos on our site. So really great. Another one. This was in Jersey City, and actually have a place in Jersey City as well, because when Manhattan shut down the STRs, Jersey City actually was a great place because all those short-term rentals and Airbnbs were allowed in Jersey City. But these two guys own this cafe here. They were worried because their landlord, the seller, was about to sell, and so they were able to kind of pool the capital, be able to live in 1 unit, short-term rent the middle unit, which actually pays for the whole mortgage on the short-term rental, and then also operate their cafe as well, which was kind of cool to see. So lots of different kind of primary multifamily opportunities there. Now, the next thing that I'll talk about is just for, it sounds more like we're looking at co-buying and primary multifamily for the audience that's currently on, but we also have a lot of people that do something that we call rent vesting, right? And you'll hear about this from a lot of folks. This is popular, especially in New York, but a lot of, we have a ton of people who are, say, got a lot of first gen tech workers in Cupertino or Mountain View who, frankly, even a duplex or triplex, it's going to take them a long time to afford. And they really love the opportunity to own. So they'll start with a rental property, either a short-term rental or a long-term rental property, and allow themselves to build equity over time, right? And so it's a way to at least get into the market, right, and start to build that equity, get some cash flow, or at least have the rental income pay for all of the expenses, and be able to leverage the equity in the home later to grow with them. So there's a lot of advantages. Obviously, you're investing in a less expensive city. You can get in earlier. You'll hire a property manager most likely, and then you've got certain tax deductions and depreciation. So highly recommend this for folks who think it's going to take me a while to get there. So starting with a property, and we can talk about all these other kind of elements of it. So for instance, I'll give an example. I'm in the process of co-buying a property in Dillon Beach right now because I love Dillon Beach. I don't know if anyone's been there, but it's absolutely, Maureen's been there. Yeah, absolutely gorgeous place. I've been watching properties for a while. They had a moratorium on short-term rentals. They just lifted that. So there's a number of permits there. And then they also capped the number of permits, which is a good thing. So you have supply constraint. There happens to be 5 or 6 properties on the market there right now, which never happens. Usually it's 1 or 2 per quarter. So it's a bit softer right now too. So I'm kind of going in and going to own with a few other people. For me, it's also house hacking my lifestyle. I'm just going to be very personal and honest. We decided to stay in the city where we have a little less space. I really want to have the space and be able to be near the ocean and have the rolling hills and get away. And I also want it to be able to kind of pay for itself. So I'm going in on a Dillon Beach place. We have data in our system that looks at what the short-term rental rates would be, what comparable Airbnbs are there, and then obviously the local short-term rental regulations. Like in this story, Selena and Wade actually live in Brooklyn, and they can't afford a place in Brooklyn, right? They're two friends. They each have their own apartments in Brooklyn. Um, but they're kind of tired of not being able to afford and own something. So they buy in Hudson Valley instead, right? And so they now have a rental property that they spend time in that pays for itself based on the short-term rental, actually comes up a bit profitable every month. And then they're also gaining equity from that property. So it's a strategy that we're seeing a lot more young folks kind of utilize. I have people 22, 23, 24 saying, if I'm ever going to own, I'm going to get into, say, a rental property initially. And so they
Hmm.
obviously do and so we joke that we have an acronym for it at Nestment. We call it the SHIFT group because its second home is the first time buying. So it's like taking a non-traditional pathway, but one that makes a lot of sense if you have the right data.
So we're seeing the people who are renting their own home, the place that they live in, they're renting,
Yes.
but they do want to get into real estate. And so this is a way for them to be able to own real estate. And then maybe with the gained appreciation, once it appreciates, they would be able to sell that and actually be able to afford their own home. So that it's kind of an interesting concept, though. The shift,
Yeah.
I love.
Yeah,
Second
well,
home is the
and
first
Selena
in.
and Wade are selling this, 3, 4 years later, and they actually made enough equity on it that they're buying a larger place. They're actually 1031 exchanging it into a larger place, and then they'll do it one more time probably so that they can then afford their Brooklyn place.
Mhm.
Right? So they're making their way there. And then the last, this is actually one of my co-founders, Mark. He was one of the ones who actually originally got Nestment, the name, the URL, and he worked for me for a number of years. He lives in San Francisco, originally from San Diego. He and three buddies, all who wanted to own, were like, let's start with a rental property first. They called their little group pin seekers because they like to play golf together. They looked at the top 100 public golf courses. They saw one that was outside of San Diego in Borrego Springs. They were able to put down as little as around 5,000 each, and were able to purchase this property. It's actually in the past kind of year and a half, it's gone up nicely, and it is cash flow positive, which is great. And so it's a place to start, right? That's the most important thing, I think, is that for him, it's like, hey, I'm living in these very expensive places. I'd love to just start, building equity and being able to own. So, the other thing that we talk a lot about, so any of these strategies can be done by an individual or by a couple, or more and more we have unmarried partners who are buying their home first before getting married, which is an interesting trend that I think we're seeing a lot more of. Um, but it's also, with friends or family, right? And so we can get into depth here, but obviously there's a number of advantages. You can dramatically reduce your down payment. You can split expenses and responsibilities. It just opens up a lot more possibilities in terms of what you can buy. Obviously, there needs to be a lot of good goals and alignment. So we have like a survey that we give you, and making sure that we get your goals are aligned. And also, one thing we always bring up are like the right schedules, like how is this going to work so that you're all on the same page with your lender and your agent. And then we have all types. I'll give it, when I did my first co-buy, I spent over $10,000 on an operating agreement. And I looked at it and I said, this was kind of just a decision tree. So we spent time and money getting all of these different templates for folks, and we just give them away for free. Like, you could obviously have a lawyer check on them and so forth, but we've gotten them vetted, and so we have people who go into it, and even if they're just co-owners and they're holding title together, just as individuals holding title as tenant in common or joint tenancy, which we can go through the differences, people still love to have an operating agreement in place, right? So and that's really important. And most of the time people will take it into not the lending in tenant in common or buying in tenant in common, but title in tenant in common after it's purchased. We also have a way, if there's more than four people, with the lenders we work with, they'll allow for you to transfer into an LLC without what's called a do sale on clause. Because when you transfer a property, technically they could make you sell that property if you transfer title. But we work with the lenders if, like, for instance, there were 8 people who wanted to get involved, and so they wanted to own it in an LLC. There is ways to do that, but the majority, especially if we're talking about parents and adult children, it's typically held as 1 to 4 people on a qualified mortgage, primary mortgage. And again, you oftentimes primary multifamily mortgage as well. We just had one the other day where they bought a home with an ADU, and the couple and their son are living in the ADU because it's 2 bedroom, 2 bath, and they're renting out the house, and it's paying for everything, which I really love, right? Like, and there's all types of opportunities there. So we just have to kind of look for them and do the math around them. This was Emily and Kim. One of the other cool things we see are like roommates coming together, right? And being like, we already live with each other. Why don't we just not pay rent and live together? And they were in a running group together as well. And they would always go by SoFi Stadium and so they got a place that has a ADU and a granny unit. Kim is actually one of our coordinators now. Almost every single one of our new hires has been a customer of ours as of recently, so which is really really cool. Just to see that. So yeah, I think that's kind of I went through a lot, I know, and I'm happy to go back. I could obviously go through more, but I don't want to kill you all with slides and stuff. But I think to just go back to the beginning strategies, if we were to kind of summarize the three strategies, the three strategies that we see towards ownership that work very well are: one, looking at getting a 2 to 4 unit property, living in one unit, renting out the others. Um, Also potentially doing that as an individual couple or as a co-buying group, parents and adult children. And then the second is if that's not a possibility, because I always look wherever you can replace your rent, let's look for that opportunity first, as well as wherever you can get a primary mortgage rate and you can get primary deductions on your taxes. Let's always look at that first. But if that's not a possibility, then we go to rent vesting, which is at least getting folks into the game by being able to own an investment property first and gain equity from that. So we what we do is we work with the agent. We actually are free,
And
and
you have to tell them about your website. Niles,
oh
where
yeah.
your website is.
Which one? Which one?
Your Nestment web. Yeah,
Oh
it's
yeah, yeah,
just you
yeah.
can go.
So Nestman is our website, and what we do is people come in and we work. We do a discovery call with them. You work with one of our we call our coordinators, right? And our we call our platform a planner. So think about like wedding planner and coordinator, or whatever. But like, and what we do is we work with you to. In this case, Gene would already know of some different properties in mind, and what we would do is put the properties into the analysis, and you can do it as well. We would teach you how to do it as well. We also would help with any of the legal agreements and so forth. So normally when people come to us and they don't have an agent, what we'll do then is, like, for instance, if someone comes to me and is looking in San Mateo County, I'll then take them through and then introduce them to Gene at the end. Once they're pre-approved, they're aligned, because what I don't want to do is waste Gene's time, right? with someone who might not be serious. So we go through this kind of 5-step process of like goal alignment, financials and ROI, agreements and legal, lender pre-approval, and then the agent gets the that person. And we make money off sharing commission with the agent. Our commission is higher when we bring the client, and then it's lower when because we have a lot of agents who will bring us clients too and say, hey, can you help them work through all of this? So the great news is there's no cost to you. We're able to share the commission, the buying agent commission, with the agent.
I was going to ask you to speak to, like, in that operating agreement, uh, deciding who the decision maker is going to be
Yeah.
and what the exit plan is. Can
Yep.
you talk to that a little
Yeah,
bit too? What?
definitely. Yeah, so there's a you usually will choose a manager of the group that makes decisions, and then you'll put certain monetary caps, like can make decisions up to this amount of money. There's also an interesting ability to change equity splits if, say, like, let's say, someone's like, hey, I'm going to help with the down payment, but not any of the renovation, right? Ultimately, if you're putting more money into the renovation, you can increase your equity in the property, which becomes interesting. And then for exit plans, we usually do it on a time based. So if someone wants out of it, they give first right of refusal to the other parties, right, or other party, to buy them out. We usually we start with a desktop appraisal first in the early stages, and then eventually get it appraised if they decide to go that route. The second is they can act if someone, say, wants to sell their share. Essentially, they can open it up to family and friends. We have a templated email they can send out to family and friends and say, hey, would anyone like that? And then if they can't get through there, we actually are building more of a public exchange. But until that happens, We have kind of some hangman clauses that say if you can't come to an agreement, right, that you sell the property. Yeah, it's been so far. I mean, obviously, we've only been doing it for a few years, but I've been doing this for 10 years, and so far, everyone has been, able to find either a way out or through it, or has just decided to sell. But I will say it makes it a lot easier to have a third party say, here's the route to go, and help you execute on that.
Sorry, is there any pre-steps that you recommend before getting involved? Like, is there any like pre-approvals, or like I would assume you wouldn't narrow down the property, the exact property that you're interested in, but kind of
No,
just
no, I
alignment.
wouldn't. What I would say, Mia, is I think actually we start with a discovery call. I mean, we take people who aren't going to buy in a year or 2 years, actually, because it's really good. And then what we like to do is get everyone's ducks in a row, in the sense of like, okay, let's look at a couple example properties, but first, right? These are not properties you're actually going to have time to buy, but let's look at a couple so that you have an understanding of the financial analysis behind it, and what it's really going to look like for your budget. And then we move you to pre-approval, right? To say, okay, how much can you afford? And then we narrow that down. Then we move you to the agent, right? And so now we have everything in a row. We have a good understanding what's possible, what you can afford. And then it becomes about pattern recognition. And sometimes we'll have people who need to just save a little bit longer. Sometimes we have people who just need to get the right building, right? With that'll bring in maybe a little more income or things like that. So what I would say is there's no really the pre-step is probably reaching out, and we can have that first conversation and setting that up, and then we'll take you down that path.
And do you have situations where people don't know each other? Because you've had examples of roommates and friends, but
We
um,
do we do have situations where people don't know each other. It's been pretty few and far between. There's a larger hypothesis that at some point, I think there's this grand notion that you could match people in a way. I just find that, there's so much people conceptually like the idea, but when it really comes down to it, I think that relationship has been key, right? And I think there again, I think there's so much opportunity amongst just family and friends. I think one of the things that I've found the most interesting is that when people go down this path, sometimes they go down without knowing who their co-buyer is. But they get an example property and they say to friends or family, look, here's what I need. Would you be interested? And here's how much return you are going to make as well, right? And so you give them the platform to engage, other family and friends. And so that they almost end up finding somebody. So it's not like random people coming together, but it's actually more like someone will say, I really want to own, and this is the way I'm going to do it. And then they're empowered and educated with the right tools and data to do that.
Okay, I'm trying to figure out whether to be like the dream would be a single family house with a backyard and, all that stuff. But does it make more sense in this scenario, or at least the Bay Area market, to get like a multi whatever so that you could rent out part of your property? Is that what the easiest or best thing to do is? Or because, yeah,
Yeah,
anyway.
so when you look at rate of return, right? So I'll start with there's renting, then that's the worst because you're not getting anything back. Then you get, I mean, sometimes it makes sense to rent if you've got good rent, and obviously there's all these things to think about. I always recommend, if you are going to, and I start with a primary multifamily, and which is living in one unit and renting out the other units,
Yeah.
right? And that's mainly because, again, you have this unique opportunity to get, your a square footage at 20 to 30% less per square foot, while getting, rents that are above that, right? And then there's also the ability for a lot of people to increase their income on paper to improve their debt to income ratio, basically,
Mm.
by the rent that they're getting. And then after that, if I'm giving anybody advice, it's usually, especially young, like we work with a lot of folks in their early to mid 20s too. And we're like, hey, start with this, and then you can rent out all the units, and you can get the single family home. And now you have a rental property that's running plus your single family home, right? Or usually actually what I typically will do is actually say, start with the primary multifamily, live in one unit. Next, look for a short-term rental in a supply constrained area where there's a permit cap. Write off, accelerate the depreciation and write it off on your active income. This is a whole nother strategy, but if I was to do it step by step, I would say start with the primary multifamily, then get the short-term rental that you can leverage the tax, the accelerated depreciation on your active income. So now you've lowered your taxable basis, you're getting kind of ultimate use of both places, and then you buy your single family home. So
Got it.
give you what I think would be the exact steps of from a financial perspective, but obviously life is never exact. So, but I'm a huge fan of the primary multifamily route. And again, don't get me wrong, a lot of people still work with us and they go with a single family home. I joke that 100% of the people come for house hacking or co-buying, and about 40% actually leave realizing, oh, I can afford a single family home and that's what I want. It's totally fine, right? Sometimes it's down payment assistance programs. It's knowing I can put 5% and there will be no PMI with this particular program. Like that's also totally fine. We want people to own. That's the most important process. But if you can't make it work, then because it is very difficult to make it work in a lot of cases, then these are the other ways to make it work. And if you can make it work and be okay with it, it's a great way to start.
Yeah, that's great. Can you do co-buying with one party as a first-time buyer and take advantage of the first-time buying programs?
You can, almost all of the time you can. There are certain programs where everyone has to be an owner occupant. So that's the one thing. But a lot of the times you can use, as long as one person is a first-time home buyer and they're the primary, right? Which usually is the case, then you can use that program. There's also another way to leverage something called a nominee agreement, which we also will sometimes do, where if that person has to just be the main person on there, but someone else needs ownership rights, but doesn't necessarily, has a little complicate things, will be on title or on the note, then we create a nominee agreement, which allows them to essentially claim ownership over that portion, and then it can still be held up in a court of law. So there's a few different ways.
So that's it for this evening. Thank you so much, everyone, for joining us, and thank you especially to Niles for being with us today.
I love the minions, Gene. I have a 3 and a 6-year-old, and so it's like,
The
thank you,
popular in our
everyone.
house.
Please reach out, okay?